This Twin Peaks Investing podcast is brought to you in association with SharePad from ShareScope, the UK's #1 investment data and analysis software for private investors and traders. Visit sharescope.co.uk and discover the advantage.
Hello and welcome to the Twin Peaks Investing podcast. My name is Peter Higgins and you can find me at Conkers3. And I'm here with my good colleague, Peter, who is at Wheelie Dealer on Twitter. Now, I need to just bring you newbies and frequent flyers of this podcast up to speed with what we do. This is a completely unscripted podcast, right? With two private investors that are just talking and sharing bits of our knowledge. Pete's been at this 20 odd plus years. I've been at it about 30 years investing in the market. And it's just what we've seen in the market over the past 2 weeks, what our thoughts are about certain stocks and what's going on in and around the investment industry. So we're not professionals. We're just ordinary people, just like everybody else out there. That's trying to make a go at investing. Some of us with more success and some of us with less success than others, but we're hoping to just share some of our knowledge to enable other people to become better investors and hopefully better investors than we've been over the past umpteen years. Is that right, Pete?
Mate, it wouldn't be difficult to be better than me, but no, I mean, in truth, I mean, you know, I think listeners can benefit from the kind of things we talk about, especially newer investors. But the other thing is that I think we gain a lot for it. I mean, I definitely get a lot more discipline since I've been doing the whole wheelie dealer thing. It just, when you're sort of talking publicly about what you do and being really open with stuff, it forces discipline on you, which is brilliant. Absolutely.
I think we probably best start, Pete, with going back to what we were saying on podcast 76. Mm-hmm. This is number 77. We're recording this. It's 6:15 on the 15th of June. Now, 2 weeks ago, on this very day, we were recording 76, and we were talking about the markets being extremely volatile. And I was saying I'm still quite cautious regarding the markets. And lots of people were getting to the point where they were getting a bit bullish about the markets and saying about, oh, this could go for a run and that could go for a run and so on and so forth. And there was conversations had about whether or not we could see 8,000 or whether or not we could actually edge closer to 7,000. Now, the markets have been extremely volatile, mainly because of what's been going on regarding conversations about the US Fed and what it's going to do next, how large that's going to be regarding their next move. I think it's tonight. Is it tonight, Pete? That they're going to be announcing?
Or something, yeah.
I think it's tonight, tomorrow. They're going to announce the next increase, which there's talk whether it's going to be 0.5% move, 0.75% move. Who knows? But we'll know by Friday how the market has reacted to that. We've seen the FTSE go from our last recording, which was over FTSE 100, 7,600 plus, and it touched nearer to 7,200 just on Tuesday of the week, yesterday. And today the FTSE's up just 1.2% to 7,273, which tells me that yesterday actually touched below 7,200 actually yesterday on Tuesday. FTSE 250 is at 19,315. That's up 1.4%. So that's sub 20,000 for the first time in a long while. FTSE All Share edged above 4,000 today. That's up 1.2%. And the unloved FTSE AIM All Share is up 0.3% at 1,917.77. So that's still getting, not as much love as it should do regarding the markets. So concerns there for people who are mainly in AIM stocks or the smaller elements of the FTSE AIM index are getting absolutely hammered and have been hammered across the markets over the last. We've had Friday, Monday, and Tuesday. So 3 consecutive days of the markets getting spanked. We've had a bit of a relief today, but it will depend on how the markets react to when the Fed makes its announcement.
I wonder about the Fed announcement in the sense that I think a lot of it's probably priced in. You know, we've had what did we have? 3? I mean, it was quite astonishing, to be honest. I mean, there was what stood out for me was, yeah, we had 3 days. So that must have been, what was it? Friday, Monday, Tuesday, or maybe Thursday, Friday, Monday. And if you look on the Nasdaq composite, you know, the US tech index, you had gaps. So you had like the down candle on Thursday, then it gapped at the open to Friday, then it gapped at the open to Monday. That's incredibly unusual. I don't think I've ever seen that, to be honest. I've seen one gap a million times, but to get 2 gaps like that, and it creates an interesting setup, because if the markets do bounce, those gaps should close pretty quick. So it'd be interesting to see how it plays out. I'm tempted to put a very small, long spread bet on possibly the S&P 500, certainly on the FTSE 100 on the test system thing I run. I probably will, but I won't go big. It's not a big call. Yeah, it's not the sort of thing to get behind heavily, but I think there could be a little bit of opportunity there, and I'll have a look at that tonight.
Yeah, it's an interesting one, Pete. I think the markets will continue to be volatile.
Oh yeah,
and depending on how they react to the news, it is tonight, by the looks of it, the Fed decision. So traders are poised as to what they're going to do. My concern really is that we've got the Dow sitting at 30,504 as we speak and record this now, right? Yeah. If we end up with more volatility, the Dow is going to give up that sentimental, psychological 30,000, okay, at some point or other.
Yeah.
And when that goes, we will see capitulation. So what's capitulation? Capitulation is when you see people selling their beloved stocks, the ones that they chime in about when anybody says anything about it. If it's not bullish enough to go, oh, I've got to defend it. When those people start selling those stocks, that is capitulation. When you see people selling Microsoft, when you see people selling Apple, when you see people selling Tesla, when you see people selling, you know,
all the ones that
stocks we're talking about.
All the ones
that FTSE stocks that's beloved, Pete.
Yeah.
That everyone loves. Which ones are they?
Well, you know, mate, there's a million of them, but I'll tell you what I tend to go by for capitulation. It's when I look at my phone and I look at my portfolio and I shake my head in disbelief. And I am like, and you know, I'm swearing at the screen. I'm like, you know, I can't believe what I'm seeing. I haven't had that yet.
We've had that over the last week or so. We've had all red across the screen. I forget which day it was, where every component of the S&P 500 was red at one point during the day. I'm not sure it was Friday, or I think it might have been Friday or Monday. All red, every single one of them. That's a sign, mate. When you haven't got one pocket of strength.
I mean, what I was seeing on my stocks was I had a lot of blues. I had a lot that didn't do anything. I had a lot that were down, but not by much. And I had the odd one that was down 6-7%. And I'd expect everything to be down 6-7%, not just one or two. That's when you get capitulation.
We will see, mate. I think our portfolios need to be more diversified in the sense of there's got to be some, and I'll talk about one of the stocks that I've purchased a bit later on. You've got to have some stocks that in your portfolio are almost uncorrelated, if that makes sense, to the market.
Oh yeah.
You know, ones that will just stay there. Just a little bit of, not this woof 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 woof. It'll just stay there and hopefully have a little bit of balance in the sense of the market's going, actually, we're okay. You know, you guys go where you want. You want to drop 5%, carry on. I'm just stay where I am. If you have a couple of those in your portfolio, at least when you open, you can go, oh, there's something there to make me feel like I know what I'm doing. Because the damage is done by all the portfolio being red. When you open the portfolio and it's red, and you see people going, you know, I see fund managers saying, today's the day to just not open your portfolio, walk away, go for a walk, do this, whatever, go and hide. And I don't think you're learning it. I've said this before. You don't learn anything from hiding. You know, you learn more from when the market is not doing well. What's going on with my stocks? If the market's down 1%, why is my portfolio down 2%? What is wrong with the stuff that I've bought? What's going on there that the beta of my portfolio is twice that of the FTSE? Yeah, if my portfolio is down 3% on one day, why is that when the FTSE is only down 1% and so on and so forth? Why have I got one stock moving 10% when there's no news on that stock? Yeah, there's no news on my stock. Why is it down 10% when the market's only down 1%? You need to be thinking about these things and going back and actually researching what's going on. Is there some stuff going on with one of their peers? Ah, right, okay. So across the water in Canada and America and so on and so forth, that's been hammered. So everyone thinks that my stock's going to get hammered because that stock's been hammered. You can't find that out if you're hiding and walking along the beach or walking the dog for 12 hours going, my portfolio's crashed. I need to pack this in and go back and get a full-time job, or I just need to just hand my money over to an IFA or a wealth manager. You know, it's all about learning, Pete.
Do you know what? It's funny you talk about correlations. I feel there's been a slight change over the last few weeks. And what I'm seeing is that my boring income portfolio, which is sort of big FTSE 100, tedious, big dividend players, that up until the last few weeks had done really quite well this year, you know, for 2022 so far. This is May, obviously, June, isn't it? So that had done pretty well. And my normal portfolio had been quite spanked. Yeah. Now, what I've noticed in the last few weeks is that my income portfolio has started to soften, but my more racy stuff has actually held up relatively, you know, that obviously it's still falling more, but that relative imbalance. And I think part of it is the oil factor, because it seems to me that oil is having a bit of a pullback this week or whatever. I mean, I was looking at the chart last night and I sort of felt that the oil price looked like it was going to pull back to the 50-day moving average or whatever. But that weakness is probably hitting the oil stocks, which isn't helping some of the bigger FTSE 100 type things or whatever. And the resources plays were hit, of course.
That's going to continue. I think that, you know, we speak about a rotation, but I think what's happening is that some of the people that have made money in the commodities and oil plays, Pete, because they've been the strongest, haven't they, really, over the past 6 to 9 months for the portfolios of most people.
Been the place to be.
Absolutely,
really.
the place to be.
Yeah.
And I think they've seen the profits go in other parts of the portfolio, and they're like, you know what, best to lock some of that in. Better take some profits off BP or Shell or wherever else they made the money. And why not do the sensible thing? Because if that does roll over, you know, and the markets do go, you know what, don't matter who you are now, BP or otherwise, we're going to sell you, then your profits have been lost. I mean, there's nothing worse than having a portfolio of, I don't know, a dozen stocks with them all winning, and your portfolio's up 20%, 100% or whatever, for it then to be down to give up 50% of that, or to go into negative. Imagine that, you know, you're up, your portfolio's up, you're like, woo, 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 I'm up 50%, 100%. And then in the course of 9 months, it's negative. How demoralizing is that going to be?
Oh, I mean, psychologically, I couldn't take that myself. It's funny, I think you must have read my mind, because I'll read you the exact words of what's on my notes. I put risk of big overweight in oil / resources, diversification important. And I think it comes to the point you just made. I think what's happened over the last, you know, however many months it is, resources stocks have done well and stuff. And of course, people have been going into resources stocks. I mean, I even bought i3E started last week or whenever it was. Absolutely shocking timing. But what I think is a concern is that people are going to end up very overweight, even if you didn't deliberately buy more oil and more resources stocks. Just the simple fact that they've done better will make them relatively overweight in your portfolio. So you can end up in this situation where, as you say, you could go from a portfolio's doing really well, and then when the rotation happens, you then get caught out. So it totally makes sense it makes sense to reassess your weighting in resources and think to yourself, am I about right? I mean, I did that last week or a couple of weeks. I've been doing it for a while, and I came to the conclusion I was a little bit light on oil, but I'm still pretty light on it. I'm not massively into oil stocks, but I just wanted something just to give me a little, a nice boring dividend paying one that is going to be sort of solid, but some sort of, just to give me more exposure to that area.
I think that's a good thing to do, Pete, and it's never too late. I mean, this is the thing. We're at 7,600. We're now at 7,300. We touched below 7,200 just yesterday, and some people were selling into the Monday and Tuesday falls. It's not too late to reconsider, to reappraise what you've got in your portfolio, because you don't want to be doing it if the market goes to 6,500. You're scratching your head going, it's always best to do it into strength, I think, rather than when markets are selling. I tend not to do any selling on days like Friday, Monday and Tuesday. I tend to do some buying, which is what I've done. I have been doing for the past couple of months on and off, just small positions and big positions in certain stocks which I'm more confident in. If they're paying me a dividend, 6%, 7%, 8%, I'm happy to wait a year to see if I've made the right decision. And I think that's the best thing to do sometimes. You're talking about dividend paying stocks. If they're able to cover their dividends one and a half times, even 2 times, and they've been giving you long-term solid returns, then why not buy if it's at a 5-year low or a 6-year low or a 10-year low? If they can actually maintain some strength, if and when the markets rebound or eventually move through 8,000, or somebody comes, as we've been talking about forever and a day, how many takeovers are coming? They get taken over and they'll get bought at a premium because there's bargains to be had. And we just keep saying this about the FTSE and AIM having some really good quality global stocks, and they're going to get taken over, Pete. So, the opportunity is there to buy. Is it the right time to buy now? Who knows? How low can the market go? Who knows? But all I know is that the ones that were the bulls, Pete, about stocks a year ago or 6 months ago, it's gone very, very quiet on Twitter. Me and you often talk about this when the markets are falling. The people that were talking about their daily 1%, 2%, 3% moves are saying nothing. They're waiting until the end of the week to pluck a number out of the air to go, I'm only down 2%,
Yeah, I always say it's that thing, you need to be consistent in what you do. It doesn't matter if the markets are up, the markets are down, the markets are sideways. Just do the same things day in, day out, like a robot. And that's the way that's the way you'll make your life a lot easier. And that's the way, psychologically, it's a lot easier to cope with things. Mate, I want to ask you a question.
Go for it.
I don't know if it's an appropriate minute. I think we've done a bit on markets and that, haven't we? Mate, the other day, I noticed on the interview podcast you do, which is it Investing Matters it's called? Is that what it's called?
Investing Matters, yeah.
Yeah, I noticed you had the wonderful Chris Dillow on it, which pleased me immensely, although I have to admit I haven't got around to actually watching it yet, but it's something I do intend to do. How did you get in, you jammy whatever you are? I was well impressed.
So for those that don't know yet, I do another podcast. It's called the Investing Matters podcast. And essentially what I'm trying to do with that is speak with the professionals. Pete and I are not professionals. Speak to professionals across the investment industry.
Definitely not speaking to a professional here, mate.
So these are the fund managers, the authors, the economists, the journalists, the editors of magazines, and so on and so on and so forth. And we've had some really good luck, really, in a sense of the people that we've had on the show. I'm just trying to pull up a list here, just so I don't forget anybody from the outset. And the beauty of of what we've done is that we're able to connect with these individuals and ask them to share their investing knowledge, their experiences, their journeys, and so on and so forth. And so far, and I'll go from the beginning, so some of you will know these individuals. We've had Gavin Oldham, OBE, from the Share Centre, and done loads of other bits and pieces. He's sold the Share Centre, another business, had shares in Equinity, which Equinity's got bought by Interactive Investor. Interactive Investors now sold that business to Aberdeen.
Oh, yeah. Wow.
So you can imagine what sort of monies that's been made.
Easy people, yeah.
Absolutely. We've had Simon Young, fund manager at AXA UK Equity Income Fund. Sorry, my computer's slowing down. I think I've got too many things open here. We've had John Newman. We've had Haldy Hall. Had the wonderful Annabelle Brodie-Smith from AIC Press.
Yeah.
We've had Charlotte Ransom from Net Wealth. John Stepek of Money Week. Idle Investor Edmund Shing. Who have I missed?
Chris Dillow.
Kurt Kernow, the chap from Kernow. We had Polar Capital's George Barrow. Had some wonderful people. And of course we had Chris Dillow. Now, the thing with Chris, for me, is that he's occasionally on Twitter. And he was saying that he's essentially retiring. So I connected with him.
Was a writer.
Forgot about Tim Rogers. So how did I get him? So I contacted him. Can't forget Mark Dampier. Obviously, we'll speak about Mark Dampier in a minute as well. And Stephen Yu. That's the one I forgot. Stephen Yu as well, of Blue Whale Capital. So Elizabeth Gooch as well. I'm going to get through the names eventually. So Chris Dillow was on Twitter. He mentioned that he was retiring, and me being me, I'd not spoken to him much in the past. Obviously, read his articles, loads and loads of his articles, and I just told him about all the different individuals we'd interviewed so far, and would he be interested in being interviewed? And he was like, "I'm retiring soon." Cool, you know what I mean?
Brilliant!
And that was essentially it.
Fantastic.
He looked at who else had been interviewed, and he was like, "Yeah, I'm on it." And he had a bit more time. He said, "After this date, I'm retiring. Contact me and give me some dates after that." And that's what I did. And the beauty about what Chris shared and what all these people have shared is all the different. There's no one way of investing, right?
Yeah.
Pete's way and my way.
Different angles, isn't it? And
different angles.
Yeah.
And the way that Chris Dillow has done it is by ensuring he doesn't lose money.
Yeah.
Simple as that. And he's chosen the passive ETF investing route. So he's just gone down and said, right, okay, you know what? I'm going to buy this ETF or these ETFs, thematic ETFs, and let the market get on with what it's doing. I'm going to put the money in there and I'm going to get on with my life. And that's what he's done for 30 years, 25 years, 15 years, so on and so forth. And in retirement now, he's got a nice pot of money to just do whatever he wants with. He hasn't chased that fad, this trend, the tech, the cryptos, anything. He's just gone, going to have some passives, I'm going to buy some ETFs, I'm going to buy that, let the market do what it needs to do, and I'm going to get on with my life. Not chasing that stock, not researching this stock, just let it go. He's an economist. He knows what's going on with the markets. He tries to see what's going on and so on and so forth. And he's decided, I don't know what's best to pick, so I'm just going to buy a tracker. Just another way of doing it.
Do you know, it's really interesting because he is, he was the economist in Investors Chronicle. And I have avidly read his articles for decades, literally decades. I've read his articles as long as he's been there, probably. And even though he's an economist as such, what really comes over to me with Chris's writing is the psychology side of things. And you know what? If he came on and described himself as a psychologist, you'd believe him. Do you know what I mean? If you knew how he writes. And one of the things that obviously stands out from how he invests is that he's very self-aware, very self-knowing, in the sense that he's realized that to outperform the market is actually very difficult. And with, I guess, with his writing, with his work, with everything that goes on in people's lives, you know, he's obviously taken the view to just keep it simple. He always goes on about this. He goes on about seasonal investing. He does like seasonal investing concepts. But he always talked a lot about the 300-day moving average. And apparently it's a very simple thing that basically says if the market goes below the 300-day moving average, which I guess is what I don't know, is that the 150 week or whatever? No, it must be less than that. If it goes below the 300-day moving average, then you should sell everything, effectively be out of the market, and only be in when it's above that 300-day. I mean, I've never really looked closely at it, but it's an interesting, a very simplistic way of doing it.
I mean, whilst we were talking, he talked about the 200-day moving average. So I'm not sure whether that differs from what he said previously, but yeah. That's exactly what he said.
Perhaps it is I might have it wrong. Yeah.
To touch on what he said about, he was saying that one of the most important aspects of investing is psychology.
Yeah.
You know, and I've been banging on about that for all the time we've been on these podcasts. And this is what determines the good investors and the outperformers of investors and the ones that simply do not do well, because the psychology of the markets will buffet you and hit you and smash you and hit you some more. And when you think you can't beat you up anymore, it'll hit you some more. So if you're panicking all the while, you end up not being in the market. So you have a stock that between there and there has gone nowhere, right? But because it's gone nowhere over 1 year or 6 years or whatever, you've gone out here, you've bought back up there, and then you've sold it there, and you've gone back. You're like, oh, so you're
better off giving with it.
You couldn't give. We keep banging on about BP and Shell. You couldn't give BP and Shell away, right? You couldn't give it away, could you?
Yeah.
Right? And
I was thinking of selling them. Yeah.
What's the biggest performer of late, or one of the biggest performers? BP and Shell.
Yeah.
Now, the people that sold it when it was on its knees are sitting there going, I can't buy it now. It's gone up too far. It's just carried on. Psychology is finding a stock or a fund and thinking to yourself, right, okay, is this got the wherewithal to deal with the markets, whatever it's going to throw at it, for 3 years, 5 years, 15 years, and so on and so forth. And if it's not a fad and not a cyclical stock or a manufacturing stock, then it might do okay over the long term. You can't be trading it for every 5% move, because you're going to get hit by the market at some point and end up. And I say this to people that are traders that come and say, oh, have you managed to do that with that stock? And I'm a bit lazy, Pete, when it comes to investing, right? I don't mind the research. I don't mind doing the digging and all the rest of it. But once I think I've found a good stock, I don't want to be scalping it 100 times for 500%. I want to buy it and wait 3 years or 5 years, and hopefully from that one trade, I can make the 500%. I can't do that 500 times or 200 times or 100 times to get that percentage that I really, really want out of the stock. But some people are happy to do that every day, which is why they come onto Twitter and social media and ramp out of a stock to get that 5%, and then move on to the next one and move on to the next one. And they only tell you when they've bought it. They very rarely tell you when they've sold it. So it is what it is, mate.
It's funny, you mentioned the word Buffett in that last piece where you talked about being buffeted around by the markets. I got to tell you, a Warren Buffett snippet I heard today, and it is quite stunning when you think about it. Apparently, at the age of 16, right, 16, I mean, you think about it, right? You're 16, you've spent what? Probably a quarter of your life or a third of your life in nappies, and you know what I mean? You know, you think how undeveloped you are as a 16-year-old. By the time of 16, he was 16, he had made $50,000. Now that's in old money. Think how much $50,000 was worth in, when was that? 1940, 1950, 1950, I guess. I don't know. Think how, I mean, that is just, so he's 16 and he's made, I don't know, what would that be worth today? Millions, mate, millions. It's incredible. I got no idea how he did that.
Well, he was already selling stuff, mate. He was already selling stuff at that age. And
he didn't have the internet. He didn't have, wait, that may have been an advantage. He didn't have all the noise that we have, but I mean, to even figure out what he was doing at such a young age, it sort of shows you what a remarkable guy he is. You know, it's quite nuts.
Absolutely, mate. And it can be done. This goes back to some of the individuals I've spoken to, and if you haven't done it yet, ladies and gents, you can find it on Twitter. Investing Matters, and also ask for it on the various different audio platforms you've got. On Twitter, it's at INVMATT podcast, INVMAT podcast. The beauty of it is, Pete, and it's said to me by quite a few people here, is that the earlier you start investing, the less you have to invest. Because we always talk about compounding on this podcast.
Yeah.
You know, and it goes back to what I keep saying. You only need to be averaging 10% a year. You can get away with even 5% a year. And if you're around long enough, 20 years, 25 years, you start with 10K, half of what an ISA is per year, and you've done 20 years, you should be okay. Between 5 and 10%, that should do very, very well with regards to topping up your pension or even making you, significantly wealthier. If you're able to do 20K in your ISA going forward each year, and you start young enough, 5%, 10%, you will do exceedingly well. Yeah,
so, I mean, obviously you've got to be in the fortunate position of having that kind of wealth, to get started with. But even if you can only spare 500 quid a year, just getting in a habit as young as you can and learning what to do is going to pay off later in life. And if like me, and certainly like Pete as well, I'm sure, if you're, it's, to me, doing shares is more than just the money side of things. I actually enjoy the process and reading about the companies and all that kind of stuff. I enjoy doing it. It's what I want to be doing. So, there's that aspect as well. And I know a lot of private investors enjoy the challenge, and trying to get better. That's what we're all trying to do, isn't it? Hey, mate.
Absolutely, Pete. I think the beauty of it is the fact that we all get better. I think the longer we actually go at it, if that makes sense, we improve. And this is why I try and encourage as many people as possible to stay invested, which is part of the reasons why I started this podcast, to be fair. I wanted to encourage people to carry on learning. I wanted to have the freedom to be able to express what I'm seeing regarding the markets without anybody saying, "Oh, don't talk about that stock, don't talk about my stock." I want to be able to share what I see. And the hardest thing for me at the moment is seeing the difficulty that some people have got into because they've listened to the wrong people. And I say you shouldn't listen to anybody. You should take information from everybody, and then make up your own minds. But some people have just blindly followed the bulls into that stock, and now the markets are rolling over. You saw it Friday, Monday and Tuesday. People going, "Oh my gosh, can't believe that this stock is down at 52-week lows." This is before the markets have capitulated, Pete. This is before the FTSE's gone below 7,000. You've got all these stocks hitting 52-week lows. We've identified some of those stocks last year to say, not so sure about that one. We've identified some stocks that have done extremely well and have come down. They're not all near 52-week lows, but some of the stocks that have been ramped to, I don't know what, are at 52-week lows.
Oh, I mean, some of the falls have been absolutely horrific, mate. They really have been unpleasant.
This is a quick hello to you, our valued Twin Peaks Investing podcast listener. Whatever channel you're listening to, please make sure to subscribe and you'll always be the first to get the new episodes. Thank you for your continued support.
Hey, there was something that I picked up from a couple of sources. I think one was in Investors Chronicle and another one was I've got quite into Ian King on Sky News in the mornings. I quite like that. Do you ever have you got Sky News?
I've got Sky News. I don't watch it. I don't watch the telly that often, Pete, during the day or during the evening.
It's quite good because what I find is I can sort of read all the RNSs and stuff, on my tablet, sort of, first thing in the morning, whatever. First thing for me, it's like when I can be bothered to wake up. But then, around 10 o'clock, Ian King comes on. And he's on for an hour, and he has some really, he has a lot of, usual stuff you're going to get, but he has some really good stuff on there. Like who do you have today? Oh God, he had the CEO of Bloomsbury on today, Bloomsbury Publishing, BMY. He was on, and there was another one. Oh, he had a thing about RMG, Royal Mail, which I hold myself, and it was about the new Warrington distribution hub that they're opening up, and they had the CEO on there, and it's brilliant for things like that to actually see the CEOs having. And Ian King has been in the game a while, and he knows a lot, and he does ask some pretty good questions at time, so I quite like that. But anyway, one of the things that come up was around greenwashing, and how it looks like that a lot of companies, right, have been they've been greenwashing. So, there's a couple of great examples. Apparently Tesco have got fined by the Advertising Standards Authority over a vegan burger. I don't know what the specifics were, but presumably they've claimed something was a vegan burger and it was mooing, It's like,
oh my gosh.
So that's one. Another one, a German bank got fined by the German regulator for misreporting their emission standard, their emissions, their CO2 emissions. And apparently, then the article in Investors Chronicle sort of went on about this more and said that the way green emissions are being put in company reports is not consistent. And there's a lot of problems with it. And it looks like I can see going forward months, years, whatever, where there's going to be more focus on this. And some companies that have been, twisting the reality to suit, I think some that's going to come out. So something for listeners to keep an eye on, because it could become a bit of a problem for some of the stocks that people are holding. I've had enough problems with DEC, Diversified Energy Corporation, where they had all those problems with methane emissions and stuff. So, your share price gets hit. It's bad news. So it's just something to be aware of, really.
Absolutely. I'm going to quote. I've just been digging out a quote here from Chris Dillow, and it sits with exactly what you've just said here, Pete, in a roundabout way. There are two approaches to investing. One is to think of ways that you can make money. The other is to think of ways that will stop you losing it. And I focus a lot on the latter because I suspect that's what is easier to do. Now, one of the stocks I found, Pete, that's involved in that ESG space is trying to make it, standardize it, and also help companies fit and ensure that they don't break the rules regarding ESG.
Oh, that's interesting.
And that's going to be involved in across all different industries eventually, I think. But they're focusing at the moment on fund managers and wealth and investment industry and banking. So that company is something that I'm waiting for them to just keep growing and get themselves up there at some point or other to transition into significant growth and getting some significant revenue. I'll share that one with you because it's already on Twitter. It's called Insig AI, and the hashtag and ticker symbol is INSG. I've had it a little while. It's a baby stock, it's not something I'm recommending anyone to go and buy. If they want to go and research it if they want to. I don't like to talk about my stocks on here, so I'm just sharing that because it covers the ESG side of it and the banking element of it. But yeah, so it's about not losing money. And if you've involved, as Pete says, if you're involved in a company that's been touting all their green credentials going forward, then you might want to double check it, because there might be issues going on for them going forward.
Yeah, because it's become a thing where, you know, in the company accounts, they're all talking about what they've actually achieved green wise. And if it turns out a lot of that is a load of old nonsense, and it could be really quite awkward for a few of them. I was just looking at INSG on SharePad, and it's not showing any forecast figures on the no, it's not showing any forecast figures. I imagine it's one of those with pretty low analyst coverage and stuff.
Yeah, it's got very little coverage, mate. I tried to buy these things relatively early, if at all possible, and then wait and see what happens further down the pipe. I think the bank, or one of the companies that we're talking about regarding the greenwashing was Deutsche Bank, one of the biggest banks in the world.
Yeah, that was
and
it.
They got raided, Germany, regarding allegations of greenwashing. I think it was around the 31st of May. And the next day, the CEO of one of their units was sacked. That's how quickly that happened. Yeah. So I'm not sure whether it's him at fault or they're looking for a scapegoat. But that person, as they call it, walked the plank very, very, very quickly.
Wow.
So yeah, it's an issue to look out for. I'm hoping that Insig will benefit from it going forward, in the sense of helping companies deal with their governance issues. So we will see, Pete. We will see.
I mean, I'd imagine.
So, Pete, sorry, go on.
I'd imagine that companies like what's that big FTSE 100 one that does all the testing of stuff? Massive company. Begins with an I. Oh, that's going to kill me now, man. What one is that? It's like a big. Oh, it will come to me. It will come to me. It's basically a company that does testing in general of all sorts of stuff, chemicals, you know, like even like consumer products and that they test and all that kind of stuff. Begins with an I. Oh, that's going to kill me, man.
You've thrown me by saying it begins with an I.
Maybe it doesn't. Maybe it doesn't begin with an I at all.
Exactly.
Oh man, that's
typical of you.
Have you got a list of FTSE 100 there? We'll go through each one and I'll say, yeah, that's the one. Oh, damn, I wish I could think what it is. It's really famous.
Probably not even in the FTSE 100, mate.
Oh, no, it's massive. It's absolutely massive, mate. And it's a really, really good company. Oh, that's sorry. If I can remember, I'll if I don't remember on the podcast, I'll stick it on Twitter or something.
Lots of companies that do testing, mate. All right, come on, talk to me about some stocks, mate. We're already in
mate,
20 minutes, 25 minutes.
Before we do that, I just want to mention quickly that every year, Twin Peaks, we're trying to sort of get supportive of a charity organization. Yeah, because this, you know, the podcast is all about making money and stuff, but you know, some of us have done pretty well out of things, especially with the hard time at the moment. And if we can sort of help support a charity and see it as a way of saying thank you for the podcast we do and all the other stuff that comes out. And the charity we're recommending this year is the Backup Trust, which you can find. It's on justgiving.com/fundraising/Twin Peaks. And we're now up to £1,619 donated. So it's coming along nicely. I think the last one we got is probably Whittam. Is that Whittam Rocklaw? Whittam Rocklaw. Great work, guys. You can thank Bonnie this time. Okay, maybe I read that one out last time. Phil Sloan, good mate of mine. Sounds a fantastic charity. Keep up the good work. Cheers, Phil. And Bonnie's given us a nice big chunky donation as well. You two are fantastic. Keep up the great work. Oh, that's brilliant. Thanks, Bonnie. Yeah, I mean, Backup Trust is a spinal injury. I mean, I'm spinally injured. I'm a T3 paraplegic. And it was a charity that was set up to help with disabled skiing and stuff, getting you know, people back to doing more sort of physical activity and stuff for disabled. And they do a lot of work with kids and whatever. So, and I know the charity well. They're a good bunch of people, so well worth supporting. If you can give a donation, that whatever it is, yeah, that would be brilliant. Thank you.
Cool.
So you want some stocks?
Yeah, let's have some stocks, mate.
Right. I'll kick you off. I'll tell you what, linking to Ian King, right? One of the guys he had on there last week, I think it was the CEO, who I think his name is actually somebody Marks, of Marks Electrical, MRK. Now, I mean, from what I understand, it's sort of a bit like Curry's, you know, so it's all electrical consumer goods and whatever. They've got physical stores and they've got an online presence. And the thing that came over about it was that they're actually not that well known. You know, it's like everybody knows Curry's, everybody knows AO World and all the ones who advertise like crazy. I don't know why, but Marks don't seem to advertise much. Or I don't see them in my area. I don't know. Do you ever see adverts for Marks on telly or anything?
I saw an advert just recently, and the reason why is because it's a Leicestershire business, mate. Right. I knew it when it had its first outlet, and I used to take my young people that I used to work with. I know the guy.
Wow.
I've spoken with him quite a few times. He's done extremely well, and the beauty about what he used to do as well is that it used to employ disabled young people and young adults to actually help with the refurb of some of the machinery that he used to get and then put it out again. So he was actually very, very good with working with an organization. I'm sure you've heard of it, Pete, from back in your Mitsubishi days, called Remploy.
I remember Remploy. Yeah.
So he used to be one of those advocates, really, of making sure that everyone had a chance. And he started from one shop, Pete, one shop of stuff that had been basically returns, dented, or got the odd fault or whatever, and he'd repair them and start all over again. And it started from Leicestershire, and it's growing rapidly. And the quality of the stuff that he's got now is just growing and growing and growing and growing. But I think, you know, I'm not doing him a disservice now when I say, obviously, the lockdown years of 2020 and 2021 boosted their ability to sell quite a lot of what they sell. And I'm just hoping that it doesn't get hammered by the rollover of some of, as we've seen on some of these IPOs that happened in 2021. But it's a good company. It's revenues have done really, really well of late. You know, we're looking at sales growth for full year 2021, 78% sales growth, 56 million pounds of sales, 7.7 million EBITDA, 5.7 million net income. It's doing okay. I just hope it can sustain it. And of course, he's a big sponsor of Leicester City Football Club. So you can't be that bad, can he?
God, I can't believe I hit on one that you actually know quite well.
I know.
In a small world. MRK, looking at the chart over, well, it's only been listed about 7 months. And basically the shares have just gone down like pretty much everything. Now that's interesting because when you look at SharePad and the forecasts, so the forecast PE is 16.3, dropping to 13.9, and it's got 1.2% dividend yield next year expected, and then 1.4% the year after. Looks like the balance sheet is pretty tough with a little bit of cash, not any debt by the looks. One of the things that he was talking about on the Ian King program was how they have an advantage and they don't have an expensive hub in the way that, hang on, I got to remember, it was something about their distribution. Listeners will have to check the details, but there was something about the way they do their distribution actually keeps costs down and is a much more effective way of doing it. So I wasn't sure if they just had like 2 distribution hubs and they do everything out of those, or maybe even 1 distribution hub. I think it was something like that. And it gave them a real, benefit in terms of the cost side of things. There was something else they did. They do next day delivery or something that no one else does, apparently. There was some uniques of their offer that, sounded pretty good. And obviously
they're trying to do most of it online, Pete. So, I'm thinking about it now, and probably the 90s when I was doing that piece of work with young people. He started the business. His name is Mark Smithson. Yeah.
Right. So that's where Mark's Electrical.
1987.
Yeah.
Right. So with 35 years from one little outlet and building it to now. And his goal is to basically get it to 500 million in revenue. So he's got a bit of a way to go to that. But given his drive and his passion, he probably will achieve that. He's not an old guy. He's quite a young guy as well. So he started it.
I love those founder-led businesses who've had I mean, the one that I talk about a lot that I hold is Hotel Chocolate, HOTC. Again, it's got a guy who's been running it, who's been there for the whole thing, and it just gives a level of commitment and a level of understanding that you don't get when you've got a manager who's been flown in 2 years ago and is only there because it had the highest payoff, when he moved there, sort of thing,
Oh, you are a cynic, Pete.
Yeah, he was given, my God. He was given loads of options, and this one happened to have a better bonus scheme than the other choices,
Yeah, there's a few of those about, mate. I mean, the thing is, at the moment, Pete, going forward, the businesses that IPO'd during the latter part of 2020 and mainly in 2021, because they've got that boost of COVID boost, and equally with the ones that are already listed, a lot of them have rolled over. A lot of them have had profit warnings.
Oh, yeah.
Because it was a significant boost for them, 2021, full year 2021. Can it be replicated during a recession or when inflation is high, energy costs are high, logistic costs are high, everything is high, and including your employees they're saying, I want a 3% rise, I want a 5% rise, or we're going to strike, as in RMT and all the rest of it going on strike. I think I've said this before, 2022, 23 is going to be very, very difficult for a lot of companies. So they have to be looking at keeping their costs down. Now, the share price has rolled over. Now, if they come out in a little while and say, actually, we've done well, people are still buying electrical goods, and we've kept our margins quite high, and our costs haven't really gone up that much, they'll surprise the market. If they don't, the share price will go lower. And there'll be another one that's deemed as one of those 2021 failures, IPO failures.
Well, that's the risk you run with a stock like that, isn't it? I mean, the retail sector at the moment is not a place you sort of think, oh, yeah, I'd like to be investing there. And I guess that's the view on a stock like this. It's just one to keep your eyes on, be aware of, think about, and certainly not something to buy in any kind of meaningful way, Something that the CEO did say, and I think there's a certain amount of truth in this, is that a lot of electronic purchases are actually they're not discretionary. You have to buy them. So if your fridge goes wrong, you've got to buy a new fridge. Your telly goes wrong, you need a new telly. And obviously a lot of things are, you can put off buying a new laptop for a year or whatever it takes. But certain things, you don't have a choice. You've got to buy them, So it's an interesting one. And I think, they have an advantage in a way over Currys, in that Currys is the big monster. It's already had its fast growth rate, whereas Marks is the much smaller one that can grow fast. So, it might work out. Who knows?
It might work out. I mean, the comparison you should have regarding Marks Electricals is AO World. And remember how fast that moved during the lockdown, and that share price has rolled over as well. So it's there to be done. I think my concern regarding online at the moment is the fact that we've got a situation where whether it's discretionary or otherwise, Pete, people are reining in their spending.
Yeah,
they're reining in their spending, or they're going to have to start reining in their spending in the second half of this year. So if they don't buy something they need, i.e. the telly's broke and the cooker's broke, then we know we're in for a really, really hard time. You know what I mean?
Oh, no doubt about
and
it.
obviously some people are upgrading their TVs and their cookers and so on and so forth because they can afford it. But I think we're in for an interesting 6 months to 18 months going forward, Pete, regarding inflationary costs and costs just going higher and higher.
Oh yeah, I mean you're totally bang on with that. I mean on before we came on this podcast, as part of my ritual for warming up, I usually have Sky News on for a bit, and they had Phil Hammond. Yeah, you know, remember the old Chancellor?
Yes. Yeah.
And he was saying, you know, he said some really interesting things, and it's hard to disagree with him in that he thinks that a lot of the money printing and funding of the government's debt situation is really fueling a lot of the inflation. And he says this, you know, there's the Ukraine war, so resource prices are going up. There's a dislocations to supply chains because of COVID. And he said all these things are adding up, and he reckons, you know, it's going to be a tough few years. And if we keep doing inflationary things like every time people say, oh no, I can't afford my energy bill, the government solution at the moment is just to give everyone more money. It will come to a point that ain't going to work. You're just going to stoke more inflation. And Phil Hammond was saying it'd be better, because the only way of solving this inflationary, if it becomes an inflationary spiral and a proper full-on 1970s inflation, the only way of curing it is to provoke a deep recession, which is exactly what happened in the 70s with Maggie Thatcher coming in at the end of the 70s. And Phil Hammond's making the argument that it'd be better to take a bit of pain now and a bit of pain, you know, going over the next few years than to have really bad pain 5 years down the track or whatever.
Yeah, and I think that's what they're trying to. I think you're right there, Pete. I think that's what they're trying to do. I think the difficulty is that we've not had this sort of situation happen where we've got governments, you know, the US and the UK and everywhere else, are trying to raise interest rates to head off all the problems they've got, right? Whilst inflation is rising, Pete. Yeah.
Well,
so they want to raise interest rates to deal with the problem, but inflation's rising at the same time. I'm not sure how many times in history that's happened before. If anyone's out there knows the answer to that, please tell us.
I think that
it's rare.
That would be the normal response. If you've got an inflation problem, you have to rise interest rates. That is normally what they do. Of course, the problem is if you raise interest rates too fast, you will cause a recession, and that's where the danger is, you know. And it could become very painful.
Everything that's wrong with the actual GDP situation right now, yeah, is going towards that. It's headwinds, and the headwinds that they're trying to deal with, they're trying to deal with it by raising interest rates. Yeah, we're heading towards a recession. You don't raise the costs for everybody when you're heading towards a recession. That's what I'm trying to say.
Well, I think it's getting to the stage where I guess the real point is that there has to be pain taken somewhere, and I guess what we should be doing is protecting the vulnerable, and that's perhaps where the government isn't very good at. There was another, I don't know if you picked up on it, it was another economic headwind that came around today, and that's concerns around Eurozone bond yield levels. And we're getting that problem where you've got, as interest rates are rising, you're finding that interest rates in the weaker EU countries like Italy, Portugal, whatever, are going up a lot, whereas in the more solid countries like Germany, France, the interest rates are staying lower. And this has caused the ECB to do some emergency action today. I'm not quite sure what that will entail, but it looks like it looks like when they've got bonds that they've effectively financed that mature and they effectively get the cash, it looks like they're going to be rolling that cash into buying debt of for instance, Portugal, or debt of Italy, or whatever. I mean, it just doesn't sound very clean to me, and I think that's something to watch in coming months. We could end up with, because if you remember the last Eurozone debt crisis, which was what, 8 years ago or whatever it was, it's quite a long time ago now. It was sold when Mario Draghi came out and said, we'll do whatever it takes. Whatever it takes turned out being loads of bond price buying, which is causing the problem we've got now. So, you know, with inflation and that. So it's just yet another macro headwind that you're saying.
Absolutely, absolutely.
Mate, I've discovered the company and I was right. It does begin with an I.
Go with it. What is it?
It is Intertech.
Intertech, obviously.
ITRK, brilliant business. It's on a forecast PE of 19.8, dropping to 18.2. You get 2.7% yield, rising to 2.9. I'll tell you what, it's a really good solid. I think there's one of them to buy, tuck away, leave it. You'll probably do pretty well on it, I would think. I don't hold it, but it's certainly a stock I would consider a buying as a nice, boring whatever. But it's a really good business.
Okie dokie. I mean, it's the sort of business that's been around forever, Pete. And you want to have some of those in your portfolio that have dealt with being buffeted by the markets for decades and have still survived. That's what you want. Absolutely. You know, these new companies, we're not sure how they're going to deal with the next, traverse the next 18 months, 2 years. Yeah. Now, I'm going to share with you a stock that I've only just purchased. And the reasons why I'm sharing it with you guys is not to encourage you to buy it. I'm encouraging you to look at uncorrelated stocks. And this is one I've purchased with a view to holding for the next 3 to 5 years. And it's called Litigation Capital Management. The ticker symbol is LIT. And I've been tracking this stock for absolutely ages. I made a significant return. Forget how much now, whether it's 15 or 17-fold, buying Burford Capital many years ago, and I got kicked out of those when it got raided. Basically, the bears started attacking it, and I sold out of that, and I haven't gone back to the litigation side of things for some time. But there's a good guy on Twitter that you guys need to check out, and if you're not following him yet, his handle is Go Left Massa, Massa, Ben, and he's got some experience in the litigation space, and I've been reading about Lit for some time, and I said to him, if and when it gets near that 90 to 95 sort of level, I'll be considering it. This is about a year ago, right? And it's actually fallen at one stage during the last year below that, and I was like, "Ooh, something must be wrong here. Something must be wrong here." And it went down to about 80 pence, and I didn't buy it. It's had various bits of news over the past year and a bit. I've dipped my toe in today, and I'm hoping it will hold up during all the volatility going forward. Essentially, what do? They basically invest in litigation. They fund litigation against large
court cases. Court cases.
Yeah, court cases. Yeah. I'm not going to go into too much detail about it. If you're interested, go and do your own research on it. Ben's done his, I've done mine, other people have done theirs. Is it a stock that could hold up during what I deem to be the next 18 months of volatility? I don't know. I'm hoping if they do, and they win some of these cases that they're funding, they'll pay a larger dividend. The PE is around 14, 15 at the minute. The yield is minuscule.
Well, mate,
got it at about 0.5%.
Mate, the PE is a lot lower than that. Go on. You're talking about historic PE, which SharePad shows as 19.7. The forecast PE is 17.9. The 2-year forecast PE is 4.8. So it's actually, I would say that's a pretty, well, it's a damn low. Expected PE is very low.
Yeah.
Assuming the forecast.
We'll see, Pete. It's early days, mate. Early days. And
can I throw in a concept here that's quite an interesting one that I don't think people really know about? And that is a concept called earnings yield, right? So we talked there about LIT, and in 2 years, it's on a PE effectively of 5, right? Now, if you're on a PE of 5, if you divide 100 by 5, you get 20, right? So that means that effectively the stock, the company is generating 20% a year. Now, it's interesting on LIT that it's only actually paying a dividend of 0.4%. So if it can achieve what it wants to achieve, it's retaining a lot of capital that it can then reinvest in future litigation cases, or it can give special dividends or whatever. So if you see stocks on low PEs, think about the earnings yield, think about it, what it might mean in terms of what the company's actually generating. Because I think that often is something that's completely missed by people.
Yeah. I mean, the interesting thing today, that triggered one of the things that triggered me. I've obviously wanted the price to be near or thereabouts 90 pence, because I'm greedy and a bit cheap, and it might go lower. I've then had some more, and then I'll be fully position sized regarding it, and then leave it alone for the next 3 to 5 years. Was they've got a litigation finance agreement, Pete, for a new representative claim against Google and DeepMind. You don't go up against them people.
Wow.
I mean, they've got enough money to wrap you around and put you out of business. So the fact they've taken up that, I was like, ooh, that's interesting. They've got the money and the wherewithal to go and fight and be representatives of that particular case. So, interesting times ahead for them. We'll see what happens. But that's just one I've nibbled at today.
I believe one of the guys who runs LIT or is involved, it used to be at Burford, pretty sure of that.
Yeah, there's connections with that as well. Yeah.
Whether you are an experienced or new investor, you know how valuable it is to conduct portfolio enhancing analysis and to have easy access to data that will give you the edge. As a Twin Peaks investing podcast listener, you can access an exceptional offer via SharePad from ShareScope, the UK's #1 investment data and analysis software for private investors and traders. This special Twin Peaks offer is available to new subscribers only, and you can subscribe using the promo code TWINPETES. The incredible and exclusive offer means that monthly subscribers will get their second month free, and annual subscribers will get their 13th month free. Sign up and subscribe to SharePad today using the Twin Petes promo code, and you can save up to £69. Visit sharescope.co.uk/SharePad for further details and subscribe to the investing and trading analysis and data you need.
Another one that I made a note of the other day is PHTM, PhotoMe International. Yeah. And I'm sure.
No, I'm messing about with you because
you won't bolt them.
I did that last podcast with regards to auction technology, Pete. I'm doing that because I wanted to interrupt you.
ATG. Because
you raised auction technology group, ATG, and this Saturday, Sunday, it got tipped in the Daily Mail as a recommended buy. So you and me were onto something, and they've gone and then tipped it as well. So the prices must be around, £9 or so. So it's interesting times that other people are getting interested in that and are tipping it. So yeah, but sorry to interrupt you, mate. Carry on.
Yeah, no. So PHTM, they had results. If I might be wrong on this, but I'm pretty sure PHTM had a takeover approach last year or whatever, and it didn't happen for whatever reasons. I think the CEO has a massive stake in the company or something. Anyway, last week or whatever, they came out with a trading update or results, and things really look like they're picking up. And what is doing really well is obviously they've got this, you know, they do the passports and stuff, don't they, with the photo booths and all that kind of stuff. But the other thing that's really doing well is these laundry machines where you can, I don't know, you go to a local Sainsbury's or something, and it's got a massive, great laundry machine, and you can shove your duvet in it and things like that.
So you can't afford to buy your washing machine from Marks Electricals. You go to Sainsbury's and use the laundry there from PhotoMe. What you're saying?
No, do you know? I think if I understand it right, these laundry machines are actually really big things. So it can do things like duvet, because you can't stick a duvet.
Oh, sorry, you said duvet. I missed that.
I don't know. Okay. I might be wrong. I think, you know, people need to look into it, but it just looks like that bit of business. It's something they've been doing for 2 or 3 years that they've gone into, and it's doing really well. And the other one that's interesting is they're doing more in food, and they bought a juice company or something. So it does like,
okay,
you know, and of course that's healthy, isn't it? You know, it's just like juice machine. Hey, have you ever heard about pizza vending machines?
I've heard it mentioned regarding them, yes, and I've been like, really?
How nuts! Apparently, there is literally a machine, and you select what pizza, what base you want, what toppings you want, and it does you. You know, you put your card in, whatever you do, and it gives you a pizza. Like, what is that about? I just can't get my head around it.
The world is changing, Pete. The world is changing.
Is there like a little bloke in there who's like cooking it or something? I just
don't be like that.
It's mad.
Let's not be sizist on this podcast, Pete.
Mate,
little Mario.
They're big machines, so it's not saying that the person's small, all right? What it is saying is the person's a really good pizza chef. So before we get sued by pizza makers,
let's not do that. Listen, we talked in the beginning of this program about protecting people from stuff. I think it was last year we were talking about Peloton, and we talked about Big falling off the bike and the shares getting smashed and all the rest of it. Now, there was a stage where this company was $130, near enough $130 per share, Pete.
I've just seen it. Oh my God.
Yeah. Wow. And worth, oh gosh, 30 billion. Yeah, 30 billion plus.
That is a chart.
Billion. Yeah,
that is a chart.
The share price currently is $9.45, and it could go lower. And the reason why I'm mentioning it is because the cash burn is absolutely insane on this company, and they're either going to need some more money very, very soon, or they're going to deem necessary to itch a ride to seek a buyer or get bought because of the data that they've got on the people that have purchased these bikes previously. So I just want to mention that particular stock, because I think invariably some people across the US that listen to us and across the UK and Europe that bought Peloton may have already sold, or hopefully would have already sold, but it could go lower. Unfortunately, I think it's one of those stocks that was a very, very trendy stock. It was obviously overhyped. Yeah, a 40 billion plus market cap at one stage, I think. So it's one of them where I'm always quite cautious of IPOs, full stop anyway. But anything that comes out and is given a significant market cap, I'm always a bit wary of buying. I prefer to buy down here. If they were still doing the business, I'd be looking at that and thinking, ooh, from 129, 130, now sitting at 945, I'd be considering it. But I'm not sure what their cash burn will do to their revenue stream going forward, and how much they need to raise going forward. And I'm very, very cautious about that stock. The other one is Coinbase, another one that was linked to crypto that came out with a humongous market cap. And again, that one's been hit hard. So what's the moral of the story here?
Crypto is mullet,
if something IPOs and everyone's talking about it, and it goes up 100%, and you got in there early, try and get out, try and take some profit. Don't chase it. So Coinbase currently has a market cap of 11.45 billion, and that's with a price of $53.42. It's been as high as $368, right? So let's just times that by 6. You're looking at 66, 70 billion pound company at best, if not more, previously. So yeah, just don't chase these trends. Don't chase these fads. Do your own research. Listen to nobody. Listen to everybody. Make your own judgment on the information that you get and what you find. And it goes back to what I've always said on here. If you're able to research a stock and research stocks yourself, yeah, you will have more conviction in that stock because you've researched it. You know what's going on with it within the company. And if it does have a 3-month or a 6-month spell where it's not going so well, yeah, you're going to have the conviction to hold on for better times ahead. But you're also going to have the conviction to think, actually, what's going on with this company has changed dramatically. It's no longer the company I thought it was in 2020 or 2021. I need to get out now. Because despite the share price going down 10 or 20%, it could go down even lower. People have been calling the bottom of Peloton and Coinbase for the past 6 to 9 months. And now they're nearer to 52-week lows, new 52-week lows. And if you've got a stock that's at your new 52-week lows now, before the markets have capitulated, where is it going to go when and if the markets significantly capitulate? And I'll talk about another stock in a minute regarding that particular fear of mine.
You said just now that, it can fall another 20%. A stock can fall 100% from wherever it is. Yeah, it might have already fallen 99.9. It can still fall another 100%. And that's so often forgotten. Mate, I was looking at Coinbase's... Coinbase.
Did you say Queenbase, Pete?
Coinbase.
Coinbase.
I was looking at Coinbase forecasts.
You live in Windsor, mate. Not everything starts with Queen.
Oh, she's at Ascot today, mate. Well, actually, she probably isn't, unfortunately. But yeah, looking on SharePad, all it's got is forecast revenue, and they're forecasting like growth in revenue, like significant growth next 3 years going up. And you think, how on earth is that going to happen? That just strikes me as bonkers. You know what it's like, mate. It's what I always say. If it's all about valuation. If you've got a stock and you hold it and it's doing well, and the valuation goes up and goes up and goes up, and it starts to get silly, at least think of top slicing a bit, take some off, because you just end up, the higher the price goes, the more your risk is, and that's so often forgotten. It's so important to always have a valuation filter in what you do. It's going to help you buy stocks when they're at good, reasonable valuations. It's going to help you sell stocks when they get too high. It's such a great tool.
Absolutely. Now, I'm raising this again with people, and I've got pure grief for it every time I've mentioned it. I've had people block me, mute me, unfollow me, and all the rest of it. The only reason why I keep mentioning this particular stock is to protect people from losses, not to have a pop. Some people have saved themselves an absolute fortune, and some people have chosen not to do their own research and to follow other people into the stock. And Pete's already typing in the stock because he knows what I'm talking about, I think. But the stock is Games Workshop. Last year and continued this year, I've had nothing but grief from loads of people because I've been saying, watch out, be careful, watch out. And when the stock was around 120 last year, I cautioned on it, I warned on it, and I said, look out, 2022 is going to be difficult for it regarding capex and costs. Right? Yesterday, the stock came out and it's finally admitting that some of the capex and costs are impacting the company. Revenues are still going gangbusters, yeah, but profitability isn't quite what it was. Some people have started to sell. One person's even come out on Twitter and said they're shorting the stock. The stock hit £60.90 yesterday, a new 52-week low. And it's bounced today. If the cost keeps eroding their revenue growth, the profitability is going to be impacted, right? And at some point or other, with regards to round numbers, if £60 goes on Games Workshop, more people will sell. If it gets below 55, I would guess that the vast majority of people that are on Twitter that bought into Games Workshop late are significantly underwater. I've seen one person already say, I'm out, taking a 27% loss on Games Workshop from buying it around, averaging about 84 quid. Now, some people bought that stock early, and their initial purchases into that stock were 15, 20, 30 pounds. So they're still up, right? But they've been adding at 100, 105, 110. So whatever their average now is, it's nearer to 50 or even 60. So they may be at break even, right? At some point or other, these revenues that they're generating could accelerate again because they're opening new markets and they're increasing royalties and so on and so forth. And it might be a great opportunity for fresh buyers to come in at this level at 60. But if they come out and warn at any point in the next 6 months, 3 months, 6 months, or before January of 2023, that price and the horde of bulls that are in there will become capitulators of that stock. And that could easily and very, very quickly hit 50. If they come out and they go, you know what, we're doing extremely well, here's a nice juicy bonus, that stock jumps from 60 to 70 to 80 in a heartbeat because there's so many people in there that love that stock. But I cautioned on it at 120 quid and I got absolutely battered from it, for it. And I'm saying again, be careful regarding that particular stock. If it's at a base now and it starts to roll back up and go up because there's further good news when it gives its next announcement, happy days, royalties are coming in, doing extremely well, 70, 80 is there, and it could go back to 100. If it doesn't and it capitulates and goes below 60, they will be carnage, people, right? Don't shoot the messenger. Don't come on Twitter having a pop. Just do your own research. I've given my views on Games Workshop over and over again. I'm giving it again. Yeah? Pete, any words on Games Workshop?
Well, I mean, the thing that hits me with Games Workshop at the moment is it's a very weak chart. That's what I'm seeing on it. I mean, when I look at the sort of valuation and stuff, it doesn't look unrealistic, doesn't look crazy. You get a pretty nice dividend yield, fingers crossed. The issue is, as you say, it's around these cost inflation. That's the real problem. And I think it's something that all retailers, and that's essentially what Games Workshop is, all retailers face this problem. And I think I've noticed something in the markets recently where a company can have pretty good results, and all that does is stops it from falling. It doesn't make it go up. It just means the thing goes into a side. If you've had a stock that struggled for a while and then it comes out with good results, it pops on the day and maybe a day later, but then it goes into its sideways grinding phase. And
the thing with Games Workshop for me is that the revenues are still increasing. They're still doing well. The PE right now is actually quite good value, right? Yeah, it looks and they pay a reasonable dividend as well. Yeah. So long term, this stock could do extremely well. Yeah. However, if they don't maintain their margin of growth, because of the capex costs, the revenue generated and the profitability gets eroded.
Oh yeah, it would do. No, it's true, mate. We probably need to end it there, don't we? We've been talking for a while.
I'm going to give you one stock, mate. Go for one stock. Tell us one stock you've got.
Tell me the stock I've got. Let me think of a random one. ESP, Empiric Student Property.
Go for it.
Oh, sorry. I thought you were asking me about a stock I hold.
Tell us some information about Empiric then, other than it houses students.
Do you know what? That's about all I know about it. No, Empiric's interesting stock. I've held it for years.
Oh gosh.
Held it for years, mate. I've held it. I held it for not long after it listed, I think, and it went through some really difficult times, but it was tucked away in my income portfolio, which I just basically ignore. And it went through difficult, and obviously then the pandemic. So it had problems before the pandemic. And what actually happened was they had, I think his name was Tim Atkins or something like that, Tim Atley or something. I probably made that up, so apologies if I've just defamed you in public. Yeah, the previous guy who was running ESP, basically they got it wrong. You know, they were buying the wrong properties and stuff. What happened was there was a change of leadership, which is what I always want to see. Mm-hmm. They got a new CEO in and stuff, and then they got this lady called Lynn Fenner, who's the CFO, and I think she is really hot. The concern is she's actually leaving fairly soon, I believe. But she's really good, and they had a change of strategy where they just focused on student property in, you know, places like Exeter, places like York, you know, real sort of quality towns and cities with, you know, the universities there. But of course, what then didn't help was that flaming pandemic, which was a nightmare for student property companies. But, you know, they've got through it reasonably well. And I'm quite happy to stick with it. The shares have been doing all right. I mean, as we know, with high inflation, property tends to do well. So I've got no reason to sell it. I probably wouldn't particularly want to buy more of it at the moment. I don't know. You know, this is the issue. It's like, if I had cash and wanted to invest in something, would I buy more ESP in my portfolio? I probably wouldn't. There'd probably be other things I'd rather. Well, I'd probably have more. I'd rather have more HOTC, for instance. So, you know, you always got to consider these things, haven't you? Unfortunately, resources are finite. It would be lovely if they were infinite. So looking at ESP, what I'm really interested in is the yield. Yeah, it's paying a forecast dividend, or should pay a forecast dividend of 3.1%. Rising to 4.2%. It's not a bad yield, really. And I'm not sure what the discount to NAV is. It's not showing on the SharePad numbers, but obviously people can look that up. But yeah, it's a good business. Would I buy more? Probably not.
Okay, I'm going to share one last one, Pete, and I think you know this one because we've spoken about it in the past, and that's Palace Capital. That
PTA.
Announced its the REIT. Yeah. So I purchased that at 175 back in July of 2020. So I've had it just under 2 years. And it was, when I last looked, it was nearer to 280 yesterday. And unfortunately, they've
what did you pay
decided,
for it?
Or say again?
How much did you pay for it?
175. I've had 19 pence in dividends already.
You've done pretty well on it. Done well, mate.
So I bought it because it was at a 50% discount at the time to NAV. They came out and said the NAV's at 360 now, so it's still at a discount to what was 280 yesterday or thereabouts. So I've had 66% in less than 2 years. They're talking about trying to do a bit of a change up regarding their business. Still got a few units in York to sell. And they're going to parachute in a new CEO at some point, or promote somebody from within. And they're looking to reduce the discount to NAV from 360 to the price, what is now 280 odd. So we'll carry on getting a dividend at the minute. Sorry,
mate. I just noticed that the US markets had tanked, and I thought it's probably rate cut time. So here we are, showing how live and unscripted and real the podcast is. It says on CNBC, Fed hikes its benchmark interest rate by 0.75 percentage points. It's increased since 1994. So that's at the top end of what analysts were expecting.
Right. So are you telling me that the markets have absolutely tanked? Because at one point...
Not really. It looks like they've dropped. If you look at intraday, it looks like they've dropped a bit, but not...
Right. Okay. I'm just trying to find a screen that will show me it. It looks like we've had a bit of a move on the Dow.
It's doing all that, mate.
As we look and speak at the minute, Pete, the Dow is up 400 points. Okay, on the announcement. So I'll give you the range here, right?
Yeah.
The market's opened on the Dow at 30,570.
Yeah.
Yeah. And it's gone up to 30,750. Yeah. When the announcement was made, bear with me. When the announcement was made, it went whoosh, and it hit 30,185. Right. So let's just use a number there.
That's a big
600-point movement.
Wow.
Over the course of the afternoon, wallop. And then from there, it's then risen 600 points back up again. It's going to be volatile. We'll see where that finishes. It's got another, where are we now? Hour and 15 minutes of volatility ahead. So we will see. And that will dictate as to what happens with the FTSE over the next 2 days and the rest of June, and what happens to the summer. Boy, oh boy. Seat your pants stuff, folks. I'm having to move and put my light on. Pete, carry on.
Yeah, well, it's like talk amongst yourselves. No.
Yeah, so volatility, guys. I mean, imagine having a short or a long on the Dow Jones with a stop of 50 points or 100 points.
Scary.
You'd be in and out and gone. You'd be thinking, I'm up and down. It's gone. You've lost money. You can't fathom it, mate. The amount of volatility in an index that's worth absolute trillions is staggering.
It's part of the reason I don't have firm stocks with brokers when I do index trades, because you just get stopped out all the time. Just an absolute nightmare.
Oh boy. So, the couple of stocks that I nibbled at today, they might do all right tomorrow, but what will they do, for the rest of June and the rest of July? I really don't know. We will see. But, they I don't know what to say. You've literally moved in a space of 40 minutes, Pete. No, from 2 o'clock when they made the announcement to what is now heading towards 3 o'clock. You've had a 1,200-point move, yin and yang, up and down. 1,200 points in an hour.
2 o'clock US time, isn't it?
US time, sorry. Yeah. 2 o'clock US time when they made that announcement, or thereabouts. So 7 o'clock our time, and it's now 2:45. Sorry, 2:45 their time, and now 7:45 our time. But a 1,200-point move or thereabouts in 45 minutes. That's what you call volatility.
You imagine if you're leveraged on that, mate. Ouch.
Because they've stopped you out already. Even though it's bounced back, you're already out.
Oh, you're out. Yeah. That's what it does. That's what it does, mate. It hunts your
wherever your stops were on that.
Oh my gosh.
Oh my gosh.
Anyway,
let's see where it stopped. If this closes today at 31,000, it would not surprise me. They're either going to be bullish about it because they think they've got it out of the way, or tomorrow they'll be going, why are we celebrating a 0.7% move on interest rates?
The key
thing, mate. We're at 30,878 now.
Mate, the key thing...
We've moved 700 points in the last 30 minutes.
The key thing is the low from yesterday. That must hold. If that doesn't hold, then expect another down leg.
Yeah. 30, I'm telling you now, mate, just watch out, because 30,000 on the Dow psychologically is massive.
Well,
the longer that holds, the more chance the markets have of climbing higher, recession or no recession. And today that touching of 30,185 would have had people going squeaky bum, squeaky bum, squeaky bum. And now we're sitting at 30,800. Nearer it goes. We get to the week and we still haven't breached 30,000. We can relax over the weekend, but how long can we relax?
Well,
that's a positive. Markets have gone. We want the markets to go higher, and that's what's happening.
I'll be ignoring the news and whatever, and just looking at the charts tonight. And I may put a small long spread bet, provided the low from yesterday hasn't gone, and provided that I get a nice setup from today to the close of play on Wednesday. If that looks a good setup, I'm going to put a little long, maybe on the S&P 500 or whatever. Yeah. And I mean, hey, got to live on the edge, mate.
Living on the edge, mate. Living on the edge would be trading the Dow. That would be. Yeah. Talk about palpitations.
Well, when I for me, trading is over a week or so. Or over
Yeah.
It's not done in minutes because it just do my head in.
Before we go, and this is probably a long podcast. I've meant to say that I've opened a trading position. I think I mentioned it last time, but I mentioned it now on M&C Saatchi. It's just in connection with the takeover that's going on at the moment. I've bought some more of it, and I'm waiting to see whether or not this bid at over £2.20, £2.40 goes ahead. It's a naked arbitrage sort of trade I've done, in the sense of if one of them takes it over, it'll be 220, 230, 240 plus if the share price goes up, or if it's taken out by cash. It's currently sitting, I think today it was sitting at 177. So we shall see how that pans out. But I'm not advocating that anyone copies it, because if it doesn't go ahead in any way, the share price will crash.
That's SAA, isn't it?
SAA is a ticker, yeah.
It's weird, unusual ticker, that, because you'd think it'd have an M in it, wouldn't you? But there you go.
No, Saatchi and Saatchi, SAA.
Yeah. But it's M&C Saatchi, so it should be MCS. My little brain could cope with that.
Okie dokie. Right, folks, thank you ever so much again for your fantastic feedback for Twin Peaks Investing 76. We appreciate your continued support. We appreciate you retweeting it and sharing it with your followers. If you're one of those that have listened to loads of our podcasts, please just give us a little hello on Twitter and social media. Share it with your followers, and enables other people to embrace our eclectic, unscripted, ridden with mistakes podcast. And if you have enjoyed it, share it. If you have enjoyed it, give us some more feedback. All the feedback we get is written up into the main write-up I do on my website, which is at conquers3.com. And I'll be sharing your names and all the rest of it on each write-up that I do. And all the people that have given me feedback and wheelie feedback regarding 76 are going to be in the write-up accompanying this podcast. So if you want your name emblazoned on a website, give us some feedback. Until then, take care. The weather's absolutely stunning at the moment. So get out, enjoy life. It's precious. Cherish it. And lots of love. Take care. God bless.
Thank you. See you later.
Have a cracking weekend when it arrives, folks.